Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, June 26, 2026. We're Elena and Marcus.
And if I told you the Middle East just saw new military strikes today, and the Federal Reserve explicitly threatened another interest rate hike,
Right.
and a massive global technology sector was basically collapsing under the weight of demand destruction, you would probably expect the broader equity market to be in free fall.
We could expect a total bloodbath, yeah.
But today, the S&P 500 closed completely flat. But that surface level calm is, well, it's a mirage. Beneath the index level, we are tracking one of the most fragile, heavily distorted setups we've seen all year.
Yeah, to set the stage for you, we are tracking 4 critical themes emerging from today's proprietary updates so you know exactly what to expect. First, we are watching a global chip wreck.
Yeah, a violent one.
Right, a massive derating occurring in Asian memory markets, cascading directly into a huge corporate misstep right here in the U.S. Second, we have a very complex rates environment. There's a front-end Treasury rally happening right now that entirely defies some highly hawkish commentary from the Federal Reserve.
Very messy. And third, we're monitoring a massive structural shift in the energy sector. We saw the Strait of Hormuz reopening, which effectively crashed crude prices during market hours.
Got it.
But that disinflationary narrative was countered by a massive post-close geopolitical tape bomb that completely alters the risk profile for next week.
Yeah. And finally, the fourth theme involves a vicious defensive sector rotation. Capital is hiding. And that rotation is about to be heavily distorted by an impending record-breaking quarter-end pension rebalancing event. So moving to today's data, we really need to start with the macro picture and global rates, because the bond market is sending some very loud signals. Front-end treasuries rallied sharply today.
Yeah, they really did.
Specifically, the 2-year yield dropped about 3.1 basis points to 4.08%. The 10-year yield fell roughly 2.4 basis points to 4.373%.
Right.
And as a result, the 10-year, 2-year curve steepened by 0.7 basis points.
Okay, let's unpack this, because there's a glaring contradiction staring us in the face here. Minneapolis Fed President Neel Kashkari just explicitly penciled in a rate hike for 2026.
Right.
He cited broad, sticky inflationary pressures. So why is the bond market looking at a sitting Fed president, shrugging its shoulders, and actively driving yields lower? Are they just calling his bluff?
Indeed. If we apply the first principles rule here to break down the mechanics, it fundamentally comes down to how institutional bond investors weigh future probabilities against tangible spot data.
Right.
A Fed president's commentary, that represents forward guidance, its intent, or forecasting. But the bond market trades on the immediate tangible reality.
Well, what they can actually see. Exactly. And today's data deck shows a massive drop in crude oil prices. For a bond trader, falling oil directly lowers immediate headline inflation fears.
Got it.
Furthermore, we received the final University of Michigan consumer sentiment read today, showing one-year inflation expectations cooling down to 4.6%. So the market is looking at that data and choosing to trust the tangible relief in energy costs over the Fed's tough posturing.
So when dealer desks see the cost of a barrel of oil dropping, they immediately calculate that this will suppress the headline consumer price index over the next quarter.
Correct.
And if that CPI prints lower, the Fed effectively loses the data-driven justification to actually execute that rate hike Kashkari is threatening.
Yeah, that's spot on. The institutional consensus now sees the first Fed rate cut pushed all the way out to June 2027.
June 2027.
Yeah. The bond market is concluding that while interest rates are going to stay elevated for a prolonged period, the immediate threat of a brand new hiking cycle is heavily mitigated by the deflationary pressure of cheaper crude oil.
But, pricing out that risk creates a severe global divergence because the U.S. is holding rates higher for much longer compared to other global central banks.
Right, many of which are already easing.
Exactly. And that yield differential is pushing the U.S. dollar index, the DXY, to a very strong 101.37. That dollar strength is aggressively pushing the USD-JPY pair to 161.74. We are talking about a near 40-year high for the dollar against the yen.
Which is a very dangerous level.
Right. It places it dangerously close to the 161.90 intervention threshold. If it crosses that line, the Bank of Japan is likely going to be forced to step in and mechanically sell U.S. dollars to buy yen.
And to get those dollars, they often have to liquidate U.S. Treasuries, which introduces a whole new layer of volatility.
Yeah.
Which naturally bleeds over into the equity side of the equation. Because when you have a relentlessly strong dollar and domestic rates staying elevated until at least mid-2027, the valuation multiples on mega-cap technology stocks are suddenly suffocating under the weight of high expectations.
Yeah, when the risk-free rate is sitting above 4%, investors demand near perfection from tech growth narratives.
And we saw that demand for perfection break down vividly today.
We really did. Looking at our daily desk data for equities, the broader market painted a very deceptive picture. The S&P 500 closed essentially flat, down just a 0.05% to 7,354.02. But beneath that calm surface, the Nasdaq 100 dropped 1.09%, and the technology sector, the XLK, was the worst performer across the board, down 1.90%.
Yeah, and what is really critical here is tracing this sell-off back to its origin point in Asia, because it reveals a very fragile global supply chain.
The chip wreck.
Right, the global cascade actually began with the Kospi index, which collapsed 5.81% overnight. That massive drop was heavily led by major memory manufacturers like Samsung and SK Hynix.
Yeah.
And the trigger for this regional collapse was Apple and Microsoft deciding to hike their end consumer product prices.
I want to make sure the causality there is perfectly clear for you listening because it highlights how sensitive the hardware ecosystem is right now. When massive vendors like Apple and Microsoft raise the prices of their devices, the market immediately projects a drop in overall unit sales. If fewer people buy the new devices because the price point is just too high,
Right, order fewer memory chips to build them.
Exactly. Memory is the ultimate boom and bust commodity of the tech sector. The market recognized that dynamic instantly, sparking massive fears of demand destruction, which caused institutional capital to flee those Asian semiconductor heavyweights.
And that global narrative disruption regarding hardware demand was then heavily compounded by a massive corporate catalyst right here in the domestic market.
Yeah, the domestic epicenter. On semiconductor, which plummeted a staggering 23.7% today.
Just a brutal single-day move.
Yeah, and this was entirely driven by their announcement of a $7 billion acquisition of Synaptics. For context, ON Semiconductor was previously valued by the market as a pure-play data center AI stock.
Right.
But this Synaptics deal aggressively pivots them away from data centers and toward consumer edge AI and the Internet of Things. It's like a highly successful premium steakhouse suddenly pivoting to sell fast food burgers.
That's a great way to look at it.
The investors didn't buy the stock for fast food. On Semi's investors bought data center dominance, not a highly uncertain gamble on smart appliances and edge AI. So they aggressively rejected the narrative disruption and just dumped the stock.
Yeah, and that capital fleeing the technology sector didn't just sit in cash, yielding 5%. We saw it rotate aggressively into rate-sensitive defensives. Healthcare, the XLV, jumped to 3.00%. Real estate, via the XLRE, added 1.50%. And utilities, the XLU, gained 0.80%. Institutional investors are actively seeking safety in sectors that offer stable dividends and less sensitivity to growth shocks.
They are hiding.
They are.
But those defensive sectors, and really the market as a whole, are about to face a massive mechanical test. Our latest run of the desk data highlights a looming technical threat for next week.
The pension rebalance.
Right. Dealer desks are calling it the mother of all pension cells. We are looking at an estimated $30 billion to $40.1 billion of U.S. equities that are modeled to be mechanically sold for the month and quarter end rebalancing. Pension funds have strict asset allocation targets, and because equities have run up so much this quarter relative to bonds, they're basically forced to sell stocks to get back to their target weightings. Yeah,
that is standard mechanical selling. But the danger here is the backdrop they are selling into. General collateral repo rates are already sitting elevated at 3.69 to 3.70%.
Right.
And that elevated repo rate is the critical variable. When repo rates are pushing near 3.7%, it signals that the plumbing of the financial system is tight. Cash is becoming very expensive to borrow overnight.
And dealer desks rely on that cheap overnight funding to warehouse risk and intermediate large client orders.
Exactly. So if pension funds are forced to dump $40 billion in equities next week, they are selling into a market where nobody has cheap liquidity to catch the falling knife. Dealer desks won't step in to absorb that supply if their funding costs are prohibitive.
You've basically just described the exact formula for a liquidity vacuum.
Yeah, I mean, when forced institutional selling collides with high funding costs, the result is widened bid-ask spreads and amplified downward volatility. The market just lacks the structural shock absorbers right now.
On that point, this defensive rotation and the broader market's ability to absorb that pension selling relies heavily on the belief that inflation is fundamentally cooling. Which brings us directly to today's massive commodity moves.
Yeah.
Looking at the energy markets, WTI crude dropped nearly 1.79% to $70.13 per barrel.
Okay.
And Brent crude fell 2.53% to $72.90 per barrel.
And the reason for this aggressive downward pricing in oil is entirely tied to the June 14th through 18th U.S.-Iran ceasefire memorandum of understanding.
Right.
The equity and commodity market spent the entire day pricing in the reality that the Strait of Hormuz is officially reopening. This is a critical global choke point for energy. Its reopening unleashes a massive flood of delayed supply from major Persian Gulf producers like Qatar and Saudi Arabia.
Mm-hmm.
So the mechanics here are straightforward. A sudden influx of physical supply hitting the market against stable global demand drives prices back down.
But here's where it gets really interesting. That disinflationary oil narrative was completely upended after the closing bell. According to today's proprietary updates, a major post-market tape bomb just hit the wire.
Yeah, this changes everything for next week.
U.S. Central Command confirmed military strikes on Iranian missile and coastal radar sites. This was a direct retaliation following yesterday's drone attack on a commercial vessel. This is the very first military action we have seen since the ceasefire memorandum was established. The peace treaty essentially lasted less than 2 weeks.
Which raises an urgent question about the fragility of the macro environment. I mean, the equity market spent all day trading on the assumption of peace and cheap oil, rotating into defensives based on cooling inflation data.
Right.
But the hard asset markets were already signaling deep skepticism before the closing bell. This is exactly why gold remains stubbornly elevated today at $4,088.74 an ounce.
Because physical asset markets, unlike forward-looking equities, are holding on to a massive geopolitical risk premium.
Exactly. Yeah. Gold traders recognize that paper agreements are fragile. They require physical hedging against the exact type of localized military escalation that just occurred post-close. Understood.
So what does this all mean? We have multiple conflicting currents moving at high speed here. A massive tech sell-off driven by hardware demand fears. A defensive rotation preparing for a highly illiquid quarter-end pension rebalance. Bond yields falling despite hawkish Fed talk. And now, a geopolitical oil shock that just reignited in the after-hours session.
If we connect this to the bigger picture, it signals a profound shift in the current market regime. For the last 2 years, we have lived in an era of unconditional AI exceptionalism.
Right.
Companies could announce massive capital expenditures tied to AI, and the market would blindly reward them with higher valuation multiples. Well, that era is firmly over. Investors are no longer giving tech companies a free pass.
Yeah.
The scrutiny is intense. If a company deviates from the core proven AI data center narrative, exactly as Onezin Semiconductor did today, they are punished violently and immediately.
And while that severe value destruction is happening in the technology sector, the broader economy is actively pricing in a very specific and somewhat precarious environment, a stagflationary adjacent soft landing.
Yeah, a stagflationary environment implies stagnant economic growth combined with sticky, elevated inflation. We are seeing definitive cracks in the foundation of the consumer, which points to that stagnant growth. The University of Michigan sentiment miss, dropping sharply to 49.5, shows everyday consumers are feeling the pinch of sustained high prices. Furthermore, today's data deck revealed a massive advanced goods trade deficit of negative $105.8 billion.
That trade deficit figure is staggering. I mean, it suggests that while we are importing goods at high costs, our domestic manufacturing and export strength is actively waning. The domestic economic engine is stalling out while costs remain high.
Which is exactly why institutional capital is frantically hiding in healthcare and consumer staples. They are looking for businesses that sell necessities, not discretionary goods. They want companies with pricing power that can survive a period where the consumer is actively pulling back on spending.
So the ultimate takeaway for you listening to this is that you cannot trust the headline index numbers right now. You see the S&P 500 closing flat and might naturally assume it was a quiet, stable session. That headline stability is a complete illusion. Beneath the surface, the market is undergoing a vicious value transfer. Capital is being aggressively ripped out of vulnerable mega-cap tech stocks that are suffering from crowded positioning.
Yeah.
At the same time, that capital is frantically searching for safe harbors amidst an escalating geopolitical reality.
The structural integrity of the market is being tested from multiple angles simultaneously. You have currency markets threatening Bank of Japan intervention, equity markets repricing corporate strategy pivots with zero tolerance for error, and commodity markets caught in a volatile tug-of-war between physical supply gluts and sudden military strikes.
It is a highly precarious environment.
It really is.
Yeah.
Index-level complacency is masking severe single-stock and sector-level volatility.
Which brings us to the final critical variable you need to mull over this weekend. The entire rate relief rally in the bond market and the resulting defensive rotation we saw in equities today was entirely predicated on the assumption that crude oil prices were falling and inflation was cooling.
Right.
With U.S. military strikes on Iran hitting the wires after the closing bell, the ceasefire is in jeopardy. What happens to the bond market and what happens to those suffocating tech valuation multiples at Monday's open if the oil supply shock violently returns and inflation fears instantly reignite?
It's a setup that could easily force a rapid, nonlinear repricing across every major asset class the moment futures open.
Yeah. To quickly recap today's major shifts, a global semiconductor derating dragged the Nasdaq down. Treasury yields actually fell despite hawkish Fed commentary. Oil plunged during the session on a Strait of Hormuz reopening, but post-close geopolitical military strikes now threaten to completely upend next week's heavily distorted quarter-end trading.
The liquidity vacuum is set. Market participants need to be highly defensive heading into Monday.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Have a good weekend.